Hi, everyone. As you are filtering in here, I'll go ahead and do some quick introductions. We'll go over some housekeeping items, and then we will go ahead and get started. So thank you so much for joining us today. I hope you've had the opportunity to uh, be with us for part 1, 2, 3, and 4 of this webinar series. You can find some of this on our YouTube channel. This session as well will likely be uploaded to our YouTube channel. And eventually they'll be on our available available to get CPE credit from our pre-recorded area. I'm stumbling over my words already. So let's get in it. Let's go over a few things and then we'll just go ahead and get started. So first and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. You will need to answer today's poll questions as they pop up on your screen. There are 3 of them. You have to answer all 3 in order to receive that CPE credit. If you have any issues at all, please just send me a message. I'll help you get that sorted out. You will also need to fill out the survey at the end of this webinar. It will pop up for you automatically, and it will also be emailed to you in 24 hours. So you will have to do both of these things again in order to receive that CPE credit. A couple other important things to note here. If you have questions as we're going along, please use that Q&A button in the middle of your screen. If you just wiggle your mouse around, it will pop up for you. Send your Q&A questions as send your questions as you have them. We're going to do our best to address them at the end of this webinar or follow up with you via email. Again, ask those at any point. We're just going to do our best to answer them at the end. I also am going to be sending out the slides and handouts once we get started here in the chat feature. They are also uploaded directly to Zoom and will be emailed to you as well. So there are a few ways to get your hands on those slides and handouts today. So let's do a quick introduction for sales tax and more. I always forget this slide. I mentioned it briefly before. We have pre-recorded webinars with available CPE credit. Those do come complimentary with our membership to our Salt Vault, but you can also purchase those individually. So if you have questions about that, please just send me a message. I will help you sort that out. And now a couple of quick introductions. First, for our company, Sales Tax and More. Sales Tax and More, we are a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services, please reach out and ask. We'd love to answer those questions for you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well-known for his work in the e-commerce industry. And I am starting to lose my voice, I think, so it's the perfect time to hand it over to you, Mike. You can take it from here.
Thank you very much, Ellie, for that wonderful introduction. And welcome, everyone. Thank you for joining us today. We've got a lot of information to cover in the next 60 minutes. We're going to talk about what to do once you realize you have Nexus or once you realize your clients have Nexus. And we're going to go through those steps. So we're going to talk about ways to register. We're going to talk about registrations themselves. We're going to talk about VDAs or voluntary disclosure agreements, as the formal name is. We're going to talk about amnesties, prospective registrations, historic registrations, and then we're going to briefly touch on a managed audit. Once again, a lot of information. If I start going too quick, just ping Ellie and get her to ask me to slow down. All right. So, Ellie, did we have a poll question in there?
I think our poll question got pushed down to, well, we did have a poll question, so why don't we launch it? If we come across that slide, we'll skip over it, but good catch, Mike. I'm going to launch that right now. And quick reminder, you do have to answer these poll questions in order to receive CPE credit. The question is hopefully not that hard. Did you attend last week's webinar? We hope you were there. If you weren't there, please watch that recording. We had a lot of great feedback on that webinar. And Mike, answers are still rolling in pretty quick. Let's give everyone a couple more seconds, and I guess we'll see if that poll question we find it. But thanks for remembering.
I think it's going to pop up in a couple of slides from here. I didn't realize this was the slide we were on. So my shame, my fault here. But we'll skip the next poll question.
Well, we're ahead of schedule on the polls. That's no problem. We can move forward.
Yes. All right. So, as I mentioned, we're going to talk a lot about registrations today. And some of the biggest questions that we get are when and where should we register? How should we register? Once registered, how often do we file? And then people always say, well, if I'm going to do the registrations myself, what are some common issues? So, we're going to touch briefly on all of those. And remember, the worst time to find out that you have problems or your clients have problems is when the state is contacting you. When you're getting a notice of audit, when you're getting a Nexus questionnaire, a telephone call, something in the email, something in the snail mail. And the reason why that's the worst time to find out is because there are programs out there that will help mitigate past exposure if you have any. But once the state contacts you, in most states, not all states, there's one or two or three exceptions, but in most states, once the state contacts you and they keep great records, a lot of people tell me, well, Mike, state's never contacted me. And then we disclose who they are, doing like a voluntary disclosure. And the state says, oh, we contacted you on this date and left a message and no one ever got back to us. So I digress a little bit, but the what's important here is that once a state contacts you, in most instances, any of these mitigation programs are not available. So you want to be proactive. If you have issues, you want to take care of them. If your clients have issues, you want to take care of them before the state actually reaches out. All right, Ellie, here's the poll question that we should add the poll here. I apologize, everyone. All right, so we're going to continue on. So what should sellers do? Well, sellers should register whenever they have Nexus. The potential exposure is material. What they sell is taxable, and a marketplace is not responsible for collecting, or someone that you're consigning the inventory to is not responsible for collecting. By the way, materiality, I say this all the time, that's my comment, not the states. Most states believe that once you cross Nexus, you should register from dollar number one and start collecting the tax from dollar number one once you cross that threshold. I believe we have to use a little bit of common sense, but we'll talk about that in a minute here. First, let's talk about Nexus. For those of you who haven't come into any of our previous webinars, Nexus is just a fancy word that means link or connection. And when we're talking about taxes, it's the link or connection which must be present before state can require you to do anything. Before it can require you to collect a sales tax or a seller's use tax or pay its taxes, like an income tax or a consumer use tax or a franchise tax, there has to be this link with the state, which is why we say it all starts with Nexus. Because if you don't have this link with the state, then they can't require you to do anything. So no Nexus equals no problems and no responsibility. If you do have Nexus, you're going to want to look at taxability. And one of the most common answers when someone asks if something is taxable is it depends. And it's going to depend on the state and the specific facts of the situation. Taxability can be very granular. So here's an example. That first bagel, it's not sliced. It's not taxable in New York as a grocery. The second one, you slice it, you put a little smear of cream cheese on it, and all of a sudden it becomes taxable. So it's still a bagel. One case is taxable, the other is not. Now, tangible personal property by default is taxable unless there's an exemption, and there are many exemptions. And exemptions can be by item. For example, groceries we just talked about. And if something's exempt by item, you don't need an exemption certificate to buy it tax-free. It's exempt for everyone. Exemptions can be by use. We have manufacturing, if something's used or consumed in the manufacturing process. If something is being purchased for resale, those are examples of exemptions by use. It can be by entity, local governments. It can even be by project. When, like contractors out there, one project they do may be for an exempt entity. The next project is for a taxable entity. So, but by default, tangible personal property is going to be taxable. And by the way, when I say personal property, a lot of people think of, handheld items, things that we can carry. However, tangible personal property is anything that can really be seen or felt, or it's perceptible to the senses. So that tractor, that airplane, that's tangible personal property also. So some people get hung up when we're saying personal and they forget the big picture items out there. Services, on the other hand, are going to be the exact opposite of tangible personal property. Generally, services are not taxable by default, and generally services must be specifically identified or enumerated in order to be taxable. Sometimes this needs some digging. Sometimes it's not very clear. I'll give you an example. In the state of Texas, website design and hosting, that's not listed as a taxable service. However, data processing is listed as a taxable service. And for the last 30 years or so, Texas has taken the position that website design and website hosting are going to be data processing services. So it may not be in the big print. You got to do some digging and look at how the state is actually interpreting what their statutes are, how they're enforcing them. Some states, there's 4 states, they actually treat services like tangible personal property. That's Hawaii, New Mexico, South Dakota, and West Virginia. And in these states, all services are taxable, except for those that are identified as being exempt. Sometimes a non-taxable service becomes taxable when sold in conjunction with tangible personal property. And states look at what you sell through the prism of what they tax. In other words, Texas was a great example. They tax data processing. They don't have any other way to tax, or at the time, website design and hosting. So they just looked at that through the prism of what they tax. And all states do that. So sometimes, we got to worry about states stretching what is and fits common sense. Like, I don't think of website design and hosting as being data processing. We can't just use common sense or normal definition. We have to actually look at what the state's saying. And I get a lot of pushback on my next statement here. All states that have a sales tax tax at least some services at this point, and that number of services is growing every day as states are trying to get with modern times. I mean, we used to be a manufacturing-based economy. Now we're a service-based economy. So states are losing out on revenue in their minds, so they need to tax more services, and that's what they're doing. Every year we see more and more services being taxable. All right, so this is materiality. I mentioned earlier, this is my concept here. Just because the state says that you should do something doesn't necessarily mean it makes good business sense to do so. And a rule of thumb that I tell everyone I talk to, if the cost of compliance exceeds the back tax plus penalty and interest, I don't believe it makes sense to do what the state says. For example, if you cross a 200 transaction threshold in a state, well, you have nexus if it's a state that has a 200 transaction threshold. But what happens if you're selling a $5 item? Well, now you've got $1,000 in sales in the state. And um, does it make sense? I mean, if the average sales tax rate is 8%, you're looking at about $80 in tax. And whether you're going to be doing the registrations and returns yourself, I don't think you can do it for $80. I mean, time is money. The time that you spend doing this yourself is going to be hours. And then you have to do it every month because some states like Georgia are going to be a monthly filer, at least for the first 6 months. So there are some costs there. And if you outsource it to someone like us, there's actually, hard costs in that. So if the cost of compliance exceeds the back tax plus penalty and interest, does it make sense to file? I say no. Now, each one of you needs to determine what's material for you. Everyone says, well, Mike, what's material? Well, Coca-Cola, $100,000 is a rounding error. To me, $100,000 is a lot of money. So each one of you needs to work with your clients, or you need to look at your own situation and determine what's material to you. I will tell you, I can't ever make the math work if your taxable sales are $3,000 or less, and most of the time when they're $5,000 or less. So those are just some numbers there on the low side. What people think of when they're determining what's material for themselves is, what's my risk tolerance? For example, we have some people calling us and saying, Mike, I can't sleep at night. And if that's you, or you have clients like that, if they're hearing footsteps, then maybe you use a lower personal threshold. Maybe you do use that $3,000 number or the $5,000 number. If you tell me, hey, I go to Vegas every week and I've never lost, nothing bad has ever happened to me, and I don't think the states are going to find me, then maybe you use a higher threshold. Profit margins. A lot of people work with real small profit margins, 2%, or maybe you're not even making money. And this is a little bit counterintuitive. It's the people with the smaller profit margins that need to worry about this the most, because if the average sales tax rate is 8% and penalty and interest on average is 50%, of the tax that you owe, you're looking at roughly a 12% effective rate. So states usually don't come in as soon as you start collecting taxes. It may be 3, 5 if you've never registered, 7, 10 years down the road. And, when they do find you, they talk to other states. You're not going to get contacted by all 50 states, but you may be contacted by another 2 or 3 states within the next 6-month period. And if you're only making 2% and the state wants 12%, not only have you wiped out your profits for all of that time period, you may have put yourself out of business. So it's the smaller companies with smaller profit margins that need to worry about this more. Everyone says, well, Mike, I can't afford to do this. Well, it's really, you can't not afford to do this. And then capital reserves. The more money you have in the bank, if a state does come and say they want all of this money, you'll be able to pay them without hurting your operations. Now, this isn't just small companies, it's big companies. We had a $100 million company at one time that had all of their cash tied up in inventory. It was the fourth quarter. They were a retailer and they couldn't pay the state. So we had to work out a payment plan, and that can get a little bit expensive sometimes. All right, so this is the handout. Ellie's going to give you an economic nexus threshold, and this gets updated every time states make a change. And Indiana just made a change here. So that's why you see the 3/19/2024 date on the top there, because this chart has just been updated. Now, what happens if a state fines you? Well, in theory, the state can go back to the date you first started doing business. Now, that's a trick question, and that is one of the questions on a registration. When did you first start doing business? What they're actually asking is, when did your nexus begin? Not when was your first sale made. But if that was 20 years ago, in theory, they can go back there. In practice, they don't usually do that. I say usually because every once in a while, a state will break the norm. Routinely, they go back 7 to 10 years, depending on the state. It's either 7, 8, or 10 years. I don't know of any states that go back 9 years. But Texas generally goes back 7 years. I was involved in a case at one point where they were trying to go back 12 years. So just because they usually go back 7 years doesn't mean that that's all they can do. In practice, in theory, they could go back to the date that the nexus first began. All right. So when a state finds you, they're going to want the back taxes plus the penalty and interest for the entire period in question. So penalty and interest can quickly exceed 50% of the tax owed. And if they're going back 7 years or 8 years or 10 years, that can add up very quickly. And once the state finds you, the mitigation options are limited or disallowed. All right, so let's jump in here. I've got Nexus. You come to the realization, or your client realizes they've got Nexus, this link or connection with a state. The potential exposure is material, so they want to do something now. The sales are taxable, and they're selling outside of a marketplace, so they're responsible for collecting the tax. So what should they do next? So what should I do next? Well, there's a 3-step process. Number one, we've just talked about. You've determined all of these things. So the next thing you want to do is quantify past liability, if any. There may not be. You may have just crossed Nexus last month, but you may have crossed it 3, 4, 5, 10 years ago. So you got to quantify your past liability, if any, and then you got to determine the best path forward. There are different ways to register. You can register prospectively, historically. You can register through a voluntary disclosure agreement. You can register through an amnesty, or you can register and then do a managed audit. So there's a number of different options that are available to you or your clients. So how do you quantify past liability, if any? Well, we use 2 ways here. One is a quick, rough estimate. And if we're on a telephone call, and you can do this yourself too, you just want to get in a ballpark, get an estimate, a rough estimate of how much money you're going to owe. You're going to need to determine the first date of nexus for each state. Then you determine the sales by state since that first date of nexus. And then you're going to multiply the sales by 12%. Where do we come up with that 12%? On average, it's an 8% sales tax rate. Some states are going to be less. Some states will be more. And then 50% for penalty and interest. Some states will be a little bit more. Some states will be a little bit less. That number may be higher depending on how long a period we're looking at. But this is a real rough estimate. So that's the quick, rough estimate. It's going to get you in a ballpark. It's not meant to be exact, but it is designed to give you some idea of what you're going to have to pay the state if they find you. All right, the second way, and this is a little bit more exact, gets you a lot closer to what the real numbers are going to be, but it's still not going to be 100% accurate just because of how tough it is to determine the actual interest rate. So in this, for each period, because the rates constantly change over a 10-year period, and it could change 4 times a year, and you get the time value of money. So it's just you're not going to be 100% accurate. I guess you could be, but it would take so much time and effort. I think it's self-defeating. This is going to be a lot closer than a quick rough estimate. So the first two steps are the same. You're going to determine the first date of nexus for each state. You're going to determine the sales by state since that first date of nexus. And then you're going to multiply the sales by the actual sales tax rate. You're going to multiply the tax that you determine by the actual penalty rate and by the actual interest rate. So you're working with fairly real numbers. Now, we do a VDA cost benefit analysis all of the time. There are some companies out there, and we're going to talk about what a VDA is, but there's one software company in particular. They're going to tell you that if you owe more than $500, you need to do a VDA. And oh, by the way, we charge $3,500 for a VDA. Well, why in the world would you pay anyone $3,500 to remit $500 for you? So you got to make sure that the VDA makes sense. It's a great tool, and we'll get into it, but it's got to make sense. So that's where this VDA cost benefit analysis comes in. So you're going to determine the VDA look back periods, and then you're going to redo all the numbers using the VDA benefits and then compare the results. And a quick rule of thumb is you want to be saving at least as much money by doing the VDA than it's going to cost you. So if you're only going to remit $500, 50% of that is $250. If they're charging you $3,500, you're not recouping that $3,500. So, and it doesn't matter who you're doing business with. Even with us, you still want to make sure that it makes sense. It's a great tool, but just like all tools, they're usually not one size fits all. All right. So when we do an exposure review, this is what it looks like. I've got 3 pages here. These are the actual rates, the states. It's the, business to consumer sales. Sometimes, the business to business sales are in there. Each business is going to be a little bit different. But the estimated total taxable sales, estimated average sales tax rate, the estimated tax owed, the estimated average penalty rate, the penalty owed. And what this comes up with is the estimated total amount due if this state found you. And this is going back however many years the state usually goes back. Now, then we're going to go and look at the VDA look back period. Some VDAs are 36 months, some say 3 years, some say 3 years plus current years, some say 48 months, some say 4 years plus the current year. State like Hawaii is an outlier. They go back 10 years for their VDA. So then, we're going to say what the cost of the VDA is, and then the estimated total to be paid through the VDA. And then the savings is going to be between if the state found you and by doing the VDA, which is the estimated number to be paid through the VDA plus the cost of the VDA. Does the VDA make sense? So we've got a column in there, and there's also going to be recommendations. All right, Ellie, why don't we go to the next polling question? And we got this one correct. I actually asked for it on the polling question slide.
We're really getting this down after 4 years of weekly webinars. All right, so that poll question should be up for everyone. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. We just have a little bit of a quiz here for you. It's a true or false question. In theory, a state can go back to the date you first started doing business in a state. And let's give everyone a few more seconds while you just review this one, and then we can close it out and move forward.
Okay. And the correct answer is true. So most everybody is getting that correct. All right, I'm going to
Right.
change slides here while you're wrapping that up. And here are the ways to register. You can register prospectively, which is using a current date or a date in the future. You can register historically, and you can do that with or without a penalty waiver, and that's using the actual date that Nexus began. You can register through a voluntary disclosure agreement or VDA. You can register through an amnesty, or you can register and then ask for a managed audit. So prospective registrations, as I said, this is with a current or future date, and it's officially used when Nexus is newly acquired. So if I just crossed a threshold last month, this is what I'm supposed to do, register prospectively. Now, or when I get, not only, we've got to remember that Nexus is not only created by crossing thresholds, but if you have physical Nexus also. Um, so if you've had Nexus for a while, the states don't want you to do this. The states want you to do either a historic registration or a VDA. So you're not supposed to use this if you do. However, many people either don't have the ability to pay all of that back tax and penalty, or many people don't want to do it. You know, it's uh, no one ever told them they had to collect the tax, so they take the attitude, if I knew about it, I could have collected the tax. So it's just a sticking point for them. But they do want to stop the bleeding. They don't want this to go on. You know, they don't want to continue to build liabilities, so they're going to do a prospective registration also. So that's uh, why some people want to do it, even though they're not supposed to. Some problems with it. Past exposure doesn't go away. And the states are getting more aggressive. So just in the last month, Arizona and Arkansas have joined the list of states that are getting aggressive. And when I say aggressive, the states are auditing registrants, and they're not doing it right away. They let you register, and it took Illinois like 3 years before they started auditing people. And we had one client who registered on January 1st of 2019. They were supposed to be registered in October 2018, and the state of Illinois wanted that 3 months worth of back tax, penalty, and interest. So states, they're getting more and more aggressive. Right now, the most aggressive are Arizona, Arkansas, Illinois, and Wisconsin. Maine was up there, but when they did away with their 200 transaction threshold, Maine's a smaller state. I see a lot less problems in Maine now than it used to be. But if you were over $100,000 in Maine, that's going to be an issue for you. South Dakota, they ask a lot of questions, or they were asking a lot of questions during the registration process. They were usually stopping the registration. Don't know how they're doing that now. Again, South Dakota is a smaller state. When they did away with their 200 transaction threshold, we don't see very many questions at all. I do think that both Maine and South Dakota will join the list of other states, and if they see that you're doing, $300,000-$400,000 a year, that you probably crossed the nexus threshold prior to when you told them. So these are the states that we counsel all of our clients. Anyone who will listen to us, you cannot do prospective registrations in a state that's aggressive, because it's not a matter of if you're going to get audited, it's a matter of when you're going to get audited. So as I mentioned, we expect more states to follow. Now, historic registrations, this is what the states want you to do, and that's a registration which the actual date of nexus began. So the states will want back returns. They're going to want all of the back tax, all of the penalty, and all of the interest. Now, you always want to request a penalty waiver. And because, these are your first returns, it's often granted. Sometimes the state will be stingy and only grant it for one of the returns, the back returns you're doing. A lot of times you can get it for all of the back returns. We've been very successful doing this. However, you don't get anything if you don't ask for it. So you always want to request a penalty waiver. Don't waste your time asking for a waiver of interest. Almost never happens. Got to take an act of God to get interest waived. Also on back returns, sometimes a state, if you're doing 3-4 years worth of back returns, sometimes the state will allow you to do annual returns for the past years. And then if your filing frequency is going to be monthly, for the current year or the past 18 months, they'll make you use the actual filing frequency, depending on where you are in the year. So this is sometimes a much better deal than what we're going to talk about in a little bit here, because this is a lot less formal than a voluntary disclosure agreement. So the cost to do this is generally going to be a lot lower. And this is something that very often it's easier for you to do on your own or for you to do for your clients if you so choose to go that way, rather than trying to go through a voluntary disclosure agreement. All right, so let's talk about filing frequencies real quick. Very few states allow you to choose your own filing frequency. Now, some states, when you register, they're going to set your frequency by statute. I mentioned Georgia earlier. The statute in Georgia says you will be a monthly filer for the first 6 months. And then after that, after we see what your sales are, then we'll tell you what your frequency will be after that. You may stay monthly. We may make you quarterly. We may make you annual. Other states are going to set your frequency by estimated sales. If you tell them that, we do $2,000 a month, they're going to say, okay, that's going to be a monthly filer. And $2,000 in taxable sales. Some do it based upon how much tax you estimate you're going to be collected. You don't want to tell them too little, because if you tell them, oh, we're going to do $500 in sales, and you do 500,000, red flag. So you want to be fairly accurate in your estimates. And after a certain period of time, the states are going to change it anyway. These are not, your initial filing frequencies are not set in stone. And every year we see multiple changes from multiple states on our clients. Most of them are going to be to going from a less frequent to more frequent frequency. But if your sales are down, if you're having a bad year, it may go the other direction. And by the way, a lot of people say, well, once I'm filing, can we request an annual filing? It's not like Canada where, under $1.5 million, you get an annual filing. In the United States, some states say, hey, if you're paying more than $89 a year in tax, you can't be an annual filer. If I'm only paying $89 a year in tax, I'm not getting registered. That's that materiality that we talked about earlier. So filing frequencies can play a big role in some of the decisions on how you want to move forward. All right, so here's a myth. You have to register with the Secretary of State when registering for sales tax, and that's just not true. The states make it look that way. If you're going online to register online, it makes it look like you have to register with the Secretary of State. But in every state out there, there is a workaround. Now, there may be instances where you do have to register with the Secretary of State, depending on how you're creating this link or connection with the state. But if you just have an economic nexus, no physical nexus whatsoever, then you will never have to register with the Secretary of State um, because registering for sales tax. So if you're running into that issue, we had someone come to us, they had economic nexus across the whole country, and their CPA had registered them with the Secretary of State everywhere. And they came to us and we went in and deregistered them everywhere. So it's just not something that you have to do. Now, if you have employees in a state, that may be a reason that you need to be registered with the Secretary of State. But the website's going to make it look like, the state website's going to make it look like you need to register pretty much in every state. Myth number 2, registering for sales tax automatically creates an income tax nexus, and that's just not true. Now, sales tax registration does not, I don't know of any state where it's going to create income tax nexus. Now, registering with the Secretary of State can create an income tax nexus, but registering for sales tax, I don't know of any state that it's going to create income tax nexus. However, the same activities that create nexus for sales tax could also create nexus for income tax. And there are some states out there, like a Texas, that are going to automatically register you for the franchise tax or the income tax. Texas doesn't have an income tax. They have what they call the franchise tax. And then it's up to you to tell them, no, I don't need that because I don't have nexus. But it's not the sales tax registration that's creating the nexus. It's just that when you get registered, they're automatically assuming that you have nexus for the franchise tax if you have nexus for the income tax. Here's some common registration mistakes. Registering for the wrong type of tax. A lot of states make a distinction between a sales tax and a seller's use tax, or vice versa. We're seeing more and more of this since Wayfair, of people getting registered for the wrong type of tax. And, it creates issues because sometimes the rates are different. Sometimes the forms are different. So that registering for the wrong type of tax is a big deal. Registering with the Secretaries of State, we just used that, talked about that. Entering the wrong start date. Remember I said there's a little bit of a trick question. When did you start, doing business in a state? It's not the first sale that they're looking for. It's when did this link begin? When did you first have nexus? That's the date. If you put in an earlier date, they're going to want the back taxes plus penalty and interest. And we see a lot of companies, paying this when they really did not have to do it. If you do enter the wrong start date, you can always go back and amend your registration. So that's a very common mistake. And then registering through the streamlined sales tax program before knowing who's going to do your returns. We'll talk about the streamlined sales tax. I just don't think it's a good program. One of the reasons is you're locked into certain software companies. And I don't think that software companies do services well at all. I think they're a necessary evil when it comes to helping you figure out what the amount of tax to collect is and collecting it. But a company like Avalara, we should be paying the referral fees because of all the problems that they create. And the people come here for us to fix them. So, and then they stay here once we fix their issues. So you got to know who's going to be doing your returns. I mean, if you want to do business with Avalara, they're going to do your returns, and they want to register you through the streamlined sales tax program. By all means, do it, but you got to go into it with open eyes. And we're going to talk about the streamlined sales tax program a little bit more closely after we talk about VDAs and managed audits. But right now, Ellie, we want to do our third and final poll question.
Yes, and that should be joining us, or That should be up on everyone's screen right now. We want to know if you're joining us for next week's part 6 of this series. Choices are you'll be there, you can't make it, or you're most interested in this part. So we really do hope that you can join us for this next part. Again, we do have these recorded, and my answers are still rolling in pretty quick here. So let's give everyone a couple more seconds, and then we can move forward. So looks like a lot of people are joining us next week. Thank you so much. We really appreciate that.
Yes, thank you. All right, so let's talk about voluntary disclosure agreements. I thought about putting this up front because we talk about it so much throughout the presentation, but a voluntary disclosure agreement is a program that a state has, and as a reward for stepping forward voluntarily, and they're going to limit the look back period to 3 to 4 years. So, like a state like California, they go back 8 years. Their VDA look back period is 36 months. So right away, you're saving 5 years of back tax plus the associated penalty and interest. So that limited look back period is a huge benefit of a VDA. Also, just about every state out there will waive the penalty. And in a handful of states, roughly 7 or so, they're going to waive some or all of the interest. And remember, without a VDA, if the state finds you, they're going to routinely go back 7, 8, or 10 years. So the most common look back periods for states, we touched on some of these earlier, is 3 years or 4 years, or 3 years plus the current year, or 4 years plus the current year. Nevada is 8 years, Iowa 5 years, Hawaii 10 years. New Mexico does not have a VDA, but they have the managed audit program. So we'll talk about that in a moment. Some other things about VDAs, as we've been saying, they're generally not available if the state has previously contacted you. Some exceptions, Michigan will allow a VDA even though they have contacted you or they have been doing so in the past. Florida is another state. But by and large, when a state contacts you, and it could be someone called you 3 years ago, and they've got a good record of that, once you disclose who you are, because a VDA is done on an anonymous basis, so they don't know who you are until you sign who you are and send in all the paperwork and everything else, and then they come back and say, "Oh, by the way, you don't qualify for our VDA program." Now they know everything about you, so you got to make sure that the state has not contacted you. As we talked about, VDA is a great tool, but like all tools, it's not for all scenarios. And states will often try to include income tax in a sales tax VDA unless it's prohibited by Public Law 86-272 or you're exempt for some other reason. In some states, you have to specifically request an income tax VDA, like California. There's 2 separate entities that handle that. But in most states, like Texas, they're going to make you do the franchise tax VDA in conjunction with the sales tax VDA. So one of the drawbacks of the program, but this is a great tool. You just have to know when to use it. All right, amnesties. Amnesties are usually not the best program out there because they're not true amnesties. You still have to pay the back tax. And unlike a VDA, which has a limited look back period, generally there's no limitation on the look back period when it comes to an amnesty. Penalty can be waived. Some or all of the interest can be waived. Usually they're more generous when it comes to interest waivers during an amnesty. They're offered very infrequently and they're short duration, 30 to 90 days along those lines. And there's all sorts of hype out there. You better take advantage of this amnesty because if you don't, we're going to add extra penalties if we find out who you are later down the road. So there's a lot of pressure to get this done. Sometimes people panic and say, oh, I better do this. Or they hear the word amnesty and say, oh, I got to do this. This is a great deal. And usually it's not. Usually a VDA is a much better option because of that limited look back period. Now, once in a blue moon, a true amnesty is available. Right now, Tennessee has an amnesty for sales tax until 1 year after they become a full member of the streamlined sales and use tax agreement. And by the way, you don't have to sign up for that agreement. You don't have to use that registration in order to take advantage of this amnesty. We have people utilizing it all of the time. So and you got to read the fine print on these amnesties. I remember it's probably 10 years ago, Washington came out with the VDA, and it was actually better than their VDA. So in general, the VDA is going to be a much better option. In this one, it had a limited look back period, and it waived a portion of the interest as well as the penalty. So it was the much better deal. And amnesty is generally a lot less formal than the voluntary disclosure agreement. Less formal means cheaper. All right, so managed audits. This is where the audit is performed by a third party like us. The audit is supervised by the state. You can also do this yourselves, but most people do sub it out. As a reward for not having to do the work, a state will generally allow for penalty and some or all of the interest to be waived. One of the negatives, generally no limitation on the look back period. One of the positives, it's generally an option even if the state contacts you. So in California, California is very aggressive. They reach out, they tell you that they're going to start investigating you, and at that point, it's too late to do a VDA. Well, if you've got a lot of exposure, that managed audit in California, they'll generally waive penalties, and they will waive 50% of the interest, which can add up over an 8-year period. So managed audit, again, is a great tool, but generally a VDA is going to be better than a managed audit, just like the amnesty, because of that limited look back period. All right, so I've said before, I'm not a fan of this program. The biggest beneficiaries of the program are the large software companies because the states pay them to do your returns. So it's very, very profitable for them. One of the problems is you go to a company like an Avalara, they're going to get you registered everywhere. And you may not say anything because they're not charging you for the returns. And there's 24 states that are a member of the Streamlined Sales Tax Program. But now you get more potential exposure. So there's benefits and risks. To me, the risks outweigh the benefits. There's a lot less visibility into an account. If you have an account with the state, you can go in, you can actually see things, you can see correspondence. When you have one of these streamlined sales tax account, it's like a limited account. You can't see a lot of what you need to see in that account. And this is not a new program. It's been around forever. Avalara was pushing this when they were brand new. And then the states said, hey, why are all these people on this program? This is, you only get to be able to do this when you register voluntarily. And these people have a responsibility to register. I think we're going to see that again. So when that happened the last time around, all these people were getting free returns. So all of a sudden, they started disappearing one by one. And Avalara was saying, okay, now you got to pay us $65 to do a return. And I just don't think it's a great program. And if you've listened to me before, you hear all of the nightmares about software companies doing your returns. Some of those problems come from this. The home rule jurisdictions are not usually filed through the streamlined sales tax program as well, which is like Colorado and Arizona, states like that. And then the Washington business and occupation tax, which is on a normal sales tax return, it's not on the streamlined sales tax return. So you got to file that on your own or pay someone like an Everletter to do that separately. All right, so why should a business care? Well, past exposure can destroy a business. The states are continuously getting more aggressive. In many states, owners and officers can be held personally responsible for sales tax issues, even when the tax is not collected. They can generally be held responsible all in every state when the tax is collected, not remitted, but some states take that a step further. If you should have collected and didn't, you can still be responsible. Sales tax liabilities, I see a lot of attorneys get this wrong. I see a lot of accountants. They're always going to follow the assets in the sale of a company. And someone says, well, Mike, we did an asset purchase. We didn't, do a stock purchase. The liabilities are going to follow the assets. It's not like other liabilities. Sales tax liabilities are like payroll tax liabilities. So and sales tax liabilities generally survive the closure and even bankruptcy of a business or the bankruptcy of the owners. Why now? Well, states know that we're going into 6 years this June. That will be the end of, it'll be 6 years this June that we've had economic nexus. And roughly 50% of the companies out there are not compliant. The states know that, and they're coming hard. They're starting to go after companies looking for economic nexus because they know there's so much money on the table right now. As they're gearing up to track down the economic nexus, they're going to find all other types of nexus out there. And while 6 years is bad enough for economic nexus, how about if you've had an independent contractor in a state for the last 15 years? That's going to be a lot worse. Now, they're already gearing up because of economic nexus. Now, historically, when there's a recession, when states need to make up revenue, they've increased their discovery efforts. That's when they're looking for companies that they believe should paying their taxes and they're not. And even if we don't officially go into a recession because the states aren't getting any of that COVID money and a lot of states are just seeing lower revenues because for some companies, business is down. So we think we're going to see more states trying to make this up. We're going to see an increase in compliance efforts and discovery efforts. So this is really the perfect storm. And we already know that the states are coming because of economic nexus. So this is just like throwing gasoline on the fire. And at this point, any questions, Ellie?
We do. We have a good handful of questions here. So we'll probably go a few minutes over. So if you have to head out right at 12, thank you so much for coming. And we will jump right in, Mike. So if an auditor is holding up an audit that you are ready to close, can you argue for interest reprieve?
You can always argue for it. Whether you get it or not is another issue. I mean, the auditor has a certain amount of time in order to close the audit. If you're not getting any progress with the auditor themselves, you can ask for a conference with the auditor's supervisor. So yes, you want to try it, but especially if you have not gotten everything to them on a timely manner during the audit, you're less likely going to get any reprieve on that. So the answer is maybe, or it depends. That's so often the answer.
So often the answer. Okay. Are we required to register for sales tax when we hit the economic nexus, but the product is exempt from sales tax, leading to no tax due?
It depends on the state. Most states are going to say, if you don't have any taxable sales, we don't want to process your $0 returns. So we do not want you to register if you truly have no taxable sales. Now, there are a handful of states out there that say we need you to register anyway. Most of our clients choose to ignore that because in most instances, the penalty is going to be based upon the amount of back tax owed. So if you don't owe any back tax, then there's penalty will be zero, the interest will be zero. So there's no teeth in that. There are some states like New Jersey and Texas that say for every late return, there's a $50 penalty. So if they do want you to file $0 returns, it can still hit you with this $50 penalty. But again, that's small potatoes compared to the amount of money that would be owed if you owed any back tax. So most of our clients, again, do not register if they have no taxable sales. That's why we, in our steps, we look at nexus first. After we determine where we have nexus, then we look at taxability. And we look at nexus first because that's usually easier to determine than taxability. Taxability can be pretty tough sometimes. So if you want to go out and save yourself some time and energy, or if you're hiring someone like us, some money, you'll want to just concentrate on where you're taxable in the states where you do have nexus.
All right. Thank you so much, Mike. And, I think we're right at 12. Anything else you want to touch on briefly before we say goodbye?
No, I appreciate everyone joining us today. I hope this has been beneficial, and we hope to see you on the next webinar. Thank you. Bye-bye.